So let's do a quick recap on the money supply. Money supply or money act as the medium of exchange. We have discussed this in our previous lessons. Okay, in the chapter called money and banking, we discussed that there are four important functions of money, which is one of it is the medium of exchange. Right, there are few forms of money. This consists of coins, notes, current account, and deposit account. So if you look at the first one, coins often used in small purchases, right? Whereas notes often used to buy slightly more expensive items. Current account are deposits at commercial banks such as RHB Bank or Maybank, HSBC Bank, right, which can be withdrawn with the use of checks. So if you withdraw your cash using checks, so that is what we call as the current account. Whereas we have the other term, which is deposit account. Account includes savings and fixed deposits at commercial banks. So this function as a store value, okay, which can be converted into cash over a span of time. So they are also called or known as the near money. Functions of money and forms of money. So there are two different major definition of money supply. Okay, which is one is the narrow money, the other one is the broad money. So the term for narrow money is commonly known as the M1, whereas for broad money we know it is known as the M2. Okay, so coins, notes, and current account deposits can be used in the day-to-day transaction. Therefore, these items are known as the medium of exchange, whereas deposit accounts such as savings and fixed deposit perform the function of what? Store value and wealth. So what is the difference between a narrow measure and a broad measure? Narrow measure functions as the medium of exchange only, whereas broad measure functions as both as the medium of exchange as well as the store value. So let's take a look at the components of the narrow measure. Narrow measure or M1 includes of coins, notes, and current account deposits. Therefore, the function of money is what? Is medium of exchange. Whereas broader measure includes of coins, notes, current account deposit plus time or demand deposit. Plus with what? Time and demand deposit. In other words, we can also say broader measure equals to narrow measure plus time or demand deposit. Therefore, the function of money for broader measure is not only medium of exchange as well as the store of value together with the medium of exchange. So next important component is the monetary policy. So in monetary policy, we have three important tools of monetary policy, which include money supply, rate of interest, and exchange rate. So what is monetary policy? Monetary policy is the action taken by the government, mainly central bank, to change the amount of money supply in the economy. Okay, the amount of money supply in the economy can be adjusted by adjusting interest rate and exchange rate. Okay, interest rate and also exchange rate in order to manage the aggregate demand. In the fiscal policy, we discuss two components, okay, where taxation and government expenditure. So in fiscal policy, the government will adjust the tax and also the government expenditure T and G in order to manage the aggregate demand so that they can influence the economic activity. Whereas in the monetary policy, the component that the government or the central bank specifically will adjust are the rate of interest and exchange rate in order to adjust or stimulate the aggregate demand, where it will directly affect the or influence the level of economic activity. So tools of monetary policy includes changes in money supply directly, changes in the rate of interest which will indirectly affect the money supply, changes in the exchange rate which also will indirectly affect the money supply. So changes in the money supply based on the economic environment, where the central bank may adopt a measure to raise or and reduce the money supply. Right? So for instance, in order to increase the money supply, the central bank may print more money in order to increase the money supply in the economy, or the government may buy back its bonds and security, buy back the bonds and security from the private sector, or the government can or the central bank can encourage to lend more money by instructing all the commercial banks. So for example, the interlink between money supply and the level of economic activities are as follows, where if you take a look at here, R denotes rate of interest, COB means cost of borrowing, S means savings, C is consumption, I is investment. For in this case, the interlink between money supply and the level of economic activity, alright, can be described by using four important components, which are the rate of interest, cost of borrowing, consumption, and investment. Right? So if you take a look at this, if the government or the central bank increases the rate of interest, the cost of borrowing becomes more expensive, or there is an increase in the cost of borrowing. Therefore, this reduces consumption and investment in the economy. Therefore, you can see the rate of interest and the level of consumption and investment are inversely related. Therefore, you can clearly understand that the aggregate demand will reduce as the consumption and investment reduces, right? Because consumption and investment is a factor of aggregate demand, where aggregate demand is equals to consumption plus investment plus government expenditure plus the net exports. Whereas the other case is when the government or the central bank reduces the rate of interest, the cost of borrowing decreases. When the cost of borrowing decreases, it is much more cheaper to take loan. Therefore, this increases consumption and investment. Alright, so consumption mainly on the consumer durables, and as well as what in the private investment, where you can see consumption increases, investment increases. This will increase the aggregate demand, where will increase the output or national output or the economic growth of the country, as well as the employment and price. So therefore, you can see here we can easily conclude the relationship between interest rate and the aggregate demand is negative relationship, or interest rate and aggregate demand are inversely related, or there is an inverse relationship between interest rate, consumption, investment, aggregate demand, and the level of economic activities. So next, ways to increase money supply in an economy. A is by printing money. Printing money is something very direct, where you can see, for example, 1st of January 2020, let's say there's about $60 billion money rotation or money supply in an economy. When the government decided to increase the money supply in the economy by simply printing money in the economy, okay, this can be done by adding another 10 more billion, right, which gives about total of about $70 billion of money supply in the economy. So the first measure or first way to increase money supply is by printing more money. The second method that the central bank used to increase the money supply is by buying back the government bonds and security which has been sold earlier to the commercial banks and private sector. So as the government or the central bank buys back the bonds or security held by the banks, okay, the money by buying back, the central bank will pay money in return to the private sector or the commercial banks. Therefore, this will lead to an increase in the money supply in the economy, where commercial banks will loan out, they will have more money to loan out more money. As they tend to loan out more money, the private sector investment will increase, the consumer's consumption may increase, therefore this may increase the aggregate demand and increases the level of economic activity in a country. So the other way to increase money supply is by adjusting the rate of interest. Rate of interest, another name for rate of interest is price of money. Price of money is what we call as the interest rate or the rate of interest. Right? So the function of the rate of interest or the price of money, okay, when the interest rate is high, savers or depositors or lenders, okay, may tend to save or deposit money in the bank in order to enjoy more reward and return. However, during that time, that season, where during the high interest rate season, the cost of borrowing will be higher, where the borrowers or investors may not be interested in borrowing money or in increase their investment, private investment, since the cost of borrowing is higher. Whereas if the interest rate or the rate of interest is cheaper or lower, the depositors, savers or lenders may not be interested in saving their cash into the bank, whereas they may invest or they may take loans since the cost of borrowing is lower. Therefore, this may increase the consumption, investment, aggregate demand, as well as the level of economic activity. So interlink between changes in the rate of interest and level of economic activity, as we discussed earlier, R denotes rate of interest or interest rate or price of money. COB means cost of borrowing, S means savings, C is consumption, I is investment, AD is aggregate demand, Y is national output or the level of economic activity. So as the central bank reduces the rate of interest, the cost of borrowing will be falling. Therefore, the cost of borrowing is cheaper, relatively cheaper compared to last time. Therefore, this will reduce savings, increases consumption, investment, which will stimulate aggregate demand and the level of economic activity in the country. So to individuals who save money in or deposit in the bank will earn interest more. Therefore, the rate of interest is the reward or return on the deposits or saving. So during high interest rate, the amount of saving will be higher, whereas during lower interest rate, the amount of saving will be lower. Therefore, there's a positive relationship between interest rate and also amount of savings. Next, the impact for the firms, investors or borrowers. Firms and household are investors who borrow money for spending are required to pay interest. So for them, rate of interest is the cost of borrowing. So when the interest rate rises, or when the central bank increases the rate of interest, therefore the cost of borrowing will be higher. As the cost of borrowing is higher, the consumption falls and investment will fall. Alright, therefore there's a negative relationship between the rate of interest or interest rate with the consumption and investment. Therefore therefore the aggregate demand will be falling and the level of economic activity also will drop. The other way around is when the interest rate decreases, the cost of borrowing decreases, which stimulates consumption and investment in an economy. This will increase the aggregate demand as well as the level of economic activity. So changes in exchange rate. So exchange rate is known as the price or value of one currency quoted in terms of another currency. For example, $1 is equal to $4. So if you take a look at how interest rate may affect the exchange rate is through the interest rate, where you can see, look at here, assume the domestic rate of interest. We must know there are two important components there, RD and RF. RD means domestic rate of interest, RF means foreign rate of interest. Okay, when the domestic rate of interest is relatively lower compared to the foreign rate of interest, okay, local savers or depositors may not be interested to save in Malaysia, whereas they may be interested to save in the foreign countries, because the rate of foreign interest rate, the rate of foreign interest is higher compared to the domestic interest. Therefore, you can see the outflows of fund will be rising, which will cause the supply of, for ringgit Malaysia for example, is higher compared to, and the demand for ringgit is lower. As the supply for ringgit increases and demand for ringgit decreases, therefore the price of ringgit or the exchange rate falls. As the exchange rate falls, export rises and import falls. So as the export rises and import falls, you can see the aggregate demand increases because there's a positive or surplus in the net exports. As the net export is positive, therefore the aggregate demand increases. As the aggregate demand increases, the level of economic activity will rise. So the government can also increase the level of economic activity by reducing the rate of interest. So the impact can be directly through the consumption and investment, as well as indirectly through the exchange rate. That's all for today. Thank you very much.